Now we are starting with a new chapter, chapter 7, Public Finance, in which we will cover Unit 1 here, Fiscal Functions, and Overview, Center and State Finance. So here are some learning objectives which you can read it, and we have a chapter overview where in public finance this unit covers fiscal functions and overview center and state finance, which has allocation of fund, redistribution fund, and stabilization fund. So here comes an introduction. The government of all nations have important economic functions even where market constitute the basic resource allocation mechanism. The size and scope of government in market economics have grown much larger over the past few decades. The primary goal of the state means here, is to promote the general welfare of the society. What governments do or do not do will obviously have an important impact on the economic performance of an economy and the quality of life of its citizen. सो गवर्नमेंट का कुछ करना और ना करना दोनों ही इम्पैक्ट करता है इकोनॉमी पे, सिंपली कहे गए तो. देन गवर्नमेंट्स at various level involves in several operations for running the state. For example, the government raises money from various sources, incurs expenditure, consumes goods and services, borrows money, employs people, and provide key institutions such as property rights. The government also establish and administer rules and regulations and put in place policies concerning all aspects of life of people. We have experienced in our day-to-day life that the governments at various level impose many rules and regulations in an economy. Some matters still go unregulated. Similarly, most of the goods and services that we consume are provided to us by private producers. But there is a broad agreement that certain goods and services should be provided exclusively by the government. For a variety of reasons, we believe that governments should accomplish some activities and should not do others. As we know, macroeconomic is the study of economy as a whole. There are three main macroeconomic goals for any nations. The first is economic growth. If the real gross domestic product grows at a faster rate than population, then people can enjoy higher standard of living. The second goal is higher level of employment, which will ensure higher income and higher output. When unemployment occurs, it harms not only the unemployed but the society as a whole because there is loss of output that could have been produced. The third macroeconomic goal is stable price level. तीनों भी मार्क करके रहता हूँ. Inflation reduces real income and purchasing power of some people and disproportionately affects lower income families. On the contrary, deflation signals a downturn in economic activity which may cause recession or even depression and large scale unemployment. So by ensuring stable prices, an economy can avoid prolonged inflation and deflation and achieve high level of economic activity and employment. The government does not expect the economy to function automatically. Rather, it intervenes to direct them to function in particular direction. Such intervention on the part of the government is based on the belief that the objective of the economic system and the role of government is to improve the well-being of individual and households. The purpose of this lesson is to examine the economic functions of the government and to understand why the government should invariably perform them. Then we have the role of government in an economic system. We shall first consider why an economic system should be in place. The basic economic problem of scarcity arises from the fact that wants are unlimited and the resources available to any society are limited. Consequently, an economy cannot produce all economic goods and services that its member desire to have. Therefore, an economic system by which a society, household, businesses, and governments make decisions about allocating resources to produce products and about distributing those products should exist to answer the basic question such as what, how, for whom to produce, and how much to produce should be set apart to ensure growth of productive capacity. The modern society in general offers three alternate economic systems through which the decisions of resource reallocation may be made, namely the market, the government, and a mixed system where both markets and government simultaneously determine resource allocation. Correspondingly, we have three economic systems, namely capitalism, socialism, and mixed economy, each with different degrees of state intervention in economic activities. Adam Smith is often described as a bold advocate of free market and minimal government interactivity. Smith believed that government's role in society should be limited but well defined. However, Smith saw an important resource allocation role for the government when he underlined the role of government. First, in national defense to protect the nation from external violence and invasions. Second, establishing a system of justice to provide internal law and order and to protect property. And third, that is C, established and maintenance of high beneficial public institutions and public works like road, bridges, canals, harbors, and postal system that profit-seeking individuals may not be able to efficiently build and operate. Since the 1930, most specifically as a consequences of the Great Depression, the state's role in an economy has been distinctly gaining an importance, and therefore traditional functions of the state have been supplemented with what is referred to as economic functions, also called as fiscal functions or public finance functions. While there are differences among different countries in respect of the nature and extent of government intervention in economies, all of them agree on one point, that the governments are expected to play a major role in an economy. This comes out of the belief that government intervention will always influence the performance of the economy in a positive way. Richard Musgrave, in his classical treatise The Theory of Public Finance 1959, introduces the three branches of taxonomy of the role of government in a market economy. Musgrave believed that for conceptual purpose, the function of the government are to be separated into three, namely resource allocation, which will ensure efficiency. Second is income redistribution, that to guarantee fairness, and third, macroeconomic stabilization, to ensure price stability. The allocation and distribution functions are primarily microeconomic functions, while stabilization is a macroeconomic function. The allocation function aims to correct the sources of inefficiency in the economic system, while the distribution role ensures that the distribution of wealth and income is fair. Monetary and fiscal policies, the problem of macroeconomic stability, economic growth, and maintenance of high level of employment and price stability fall under stabilized function. The national budget in general reflects the economic policy of the government, and the government exercises its economic function partly through the budget. We shall now discuss in detail the conceptual three function framework of the responsibilities of the government. First, the allocation function. So, resource allocation refers to the way in which the available resources or factors of production are allocated among the various uses to which they might be put. It determines how much of the various of kinds of goods and services will actually be produced in an economy. Resource allocation is a critical function because the resources of a society are limited in supply, whereas the wants of the members of the society are unlimited. In addition, any given resource can have multiple alternate uses. One of the most important functions of an economic system is the optimal or efficient allocation of scarce resources so that the available resources are put to their best use and no wastage are there. Economic efficiency indicates a situation in which all resources are allocated to serve each person in the best way possible, minimizing the waste and inefficiency. The private sector resource allocation is characterized by market supply and demand and price mechanism as determined by consumer sovereignty and producer profit motives. The state's allocation, on the other hand, is accomplished through the revenue and expenditure activity of government budgeting. In real world, resource allocation is determined by both market as well as the government. Then, a market economy is subject to serious malfunctioning in several basic respects. While private goods will be sufficiently provided by the market, public goods and merit goods will not be produced in sufficient quantities by the market. Missing markets or non-existence of market occurs in variety of situations. Why do market fail to give the right answer to the question as to how the resources can be efficiently utilized and what goods should be produced and in what quantities? In other words, why do market generate misallocation of resources? Allocative efficiency is concerning with utilizing limited resources to produce goods and services that would maximize value of society. Allocative efficiency achieves the largest possible output of goods and services from the existing stock of resources and technology. Efficient allocation of available resources in an economy is assumed to take place only when the market are perfectly competitive and economic agents make rational choices and decisions. But in reality, market are never perfect competitive. Market failures which hinder efficient allocation of resource occurs mainly due to following reasons. So these are some important reasons. I will just mark it. First, imperfect competition and presence of monopoly power in different degrees leading to underproduction and higher prices that would exist under condition of competition. Markets may fail to control the abuses of monopoly power. Second, market typically fail to provide collective public goods such as defense, which are by their very nature consumed in common by all people. And third, incomplete market may fail to produce the right quantity of merit goods such as education and healthcare. And we have more. Fourth, common property resources, example environment, are overused and exhausted in individual pursuit of self-interest. Fifth, externalities which arises when the production and consumption of goods and service are affect third parties, that is pollution. Sixth, factor in mobility which causes unemployment and inefficiency. Seventh, imperfect information because it may not be in the interest of one party to provide full information to the other party. And last, inequalities in the distribution of income and wealth. According to Musgrave, the state is the instrument by which the needs and concerns of the citizen are fulfilled. Therefore, public finance is connected with economic mechanisms that should ideally lead to a effective and optimal allocation of limited resource. This logic, in effect, makes it necessary for the government to intervene in the market to bring about improvement in social welfare. In the absence of appropriate government intervention, market failures may occur and the resources are likely to be misallocated with too much production of certain goods or too little production of certain other goods. For example, the society may produce too much of demerit goods and too little of merit goods. The allocation responsibility of the governments involve suitable corrective actions when private markets fail to provide the right and desirable combination of goods and service. Briefly put, market failures provide the rationale for government's allocative function. Let us see a few of many examples of government's intervention in resource allocation. You might have noticed that in many cases the government can provide us with goods and service that we cannot produce on our own or buy at the market at a price from the market. For example, the government establishes property rights and make necessary arrangement for enforcing contracts to provision of law enforcement and courts. While externalities are involved in the production and consumption of goods and services, price do not reflect the true cost and benefits, and government intervenes with appropriate corrective measures. Merit goods, which are generally beneficial to the society and by and large provided by the government. Production and consumption of demerit goods are controlled with appropriate policies. These interventions do not imply that markets are replaced by government action. In its allocation role, government acts as a complement rather than a substitute to the market system in an economy. The resource allocation role of the government policy focuses on the potential for the government to improve economic performance through its expenditure and tax policy. The allocative function in budgeting determines who and what will be taxed, how much and on the government revenue will be spent, the process by which total resources of the government are divided among various uses, the optimal mix of social goods, both public and merit goods, the level of involvement of the public sector in the national economy, the reallocation of society's resources from private use to public use. A variety of allocation instruments are available by which government can influence resource allocation in an economy. For example, the government may directly produce an economic goods, for example, electricity and public transport service. The government may use the price mechanism, that is altering the market prices determined by demand and supply through influencing the taxes and subsidies, to influence private allocation by policy that change the behavior of consumer and producers. In other words, the government may direct resources allocation through incentives and disincentives. For example, tax concession and subsidies may be given for the production of goods and promote social welfare, and higher taxes may be imposed on goods such as cigarettes and alcohol so that their prices are higher. So taxes can have influence on the consumer purchasing power, and government plays a crucial role in that. Then we have the government may influence allocation through legislation and force. For example, ban of single-use plastic goods prevent resources moving into their production. The competition policy, merger policy, etc. affect the structure of industry and commerce. For example, the Competition Act in India promotes competition and prevents anti-competitive activities. Government's regulatory activities such as licensing, controls, minimum wages, and directives on location of industry influence resource allocation. Government set legal and administrative framework, and government may adopt any combination of possible remedies. Then we have the third, the redistribution function. So you may have noticed that over the past decade there has been tremendous expansion in economic activities resulting in enormous increase in aggregate output and wealth. However, the output of such economic growth have not spread evenly across the household. Socialist ideology, which emphasizes equality, created strong pressure on the redistribution role of the government. The distribution responsibility of the government arises from the fact that, left to the market, the distribution of income and wealth among individuals in a society is likely to be skewed, and therefore the government has to intervene to ensure a more socially optimal and egalitarian distribution. The distribution function of government is related to the basic question of for whom should an economy produce and goods and service. Government can redistribute income and wealth either through the expenditure side or through a revenue side of the budget. On an expenditure side, government may provide free or subsidized education, health care, housing, food, and basic goods to deserving people. On the revenue side, redistribution is done through progressive taxation. So India has a progressive taxation, that is tax rates change based on the tax rates are different based on your incomes. So if you earn till 10 lakh, you have a different slab. If you earn till 15 lakhs, you have a different tax rate. If you earn till 20 lakhs, so till 15 lakh you will get say X tax percent, and from 15 to 20 you will have a Y tax percent. Then effective demand is determined by the level of income of the household, and this in turn determines the distribution of real output among people. Therefore, the distribution function also relates to the manner in which the effective demand over the economic goods is divided among the various individuals and family spending units of the society. The distribution function of the government aims at redistribution of income to achieve an equitable distribution of societal output among households, ensuring an increased overall social welfare, advancing the well-being of those members of the society who suffers from deprivations of different types, providing equality of income, wealth, opportunity, providing security in terms of fulfillment of basic needs for people who have hardship, and ensuring that everyone enjoys a minimum standard of living. A few examples of redistribution function or market intervention for social economic reasons performed by government are as above. First, taxation policies of the government, where progressive taxation of the rich is combined with the provision of subsidy to the poor households. Second, proceeds from progressive taxation used for financing public services, especially those that benefit low income households. For example, supply of essential food grains at highly subsidized rate to BPL householders, below poverty line people. Then we have employment reservations and preferences to protect certain segment of the population, minimum wages and minimum support prices to farmers for their output, unemployment benefits and transfer payments to provide support to the underprivileged, dependent, physically handicapped, the older citizens and the unemployed. Families below the poverty line are provided with monetary aid and aid in kind. Regulations of manufacture and sale of certain products to ensure the health and well-being of consumers, and special scheme for backward regions and for the vulnerable section of the population. In modern times, most of the egalitarian welfare states provide free or subsidized education and healthcare system, unemployment benefits, pension, and such other social security measures. This is nevertheless an argument that in exercising the redistribution function, there would be a conflict between efficiency and equity. So, in other words, government's redistribution policies which interfere with producers' choices or consumer choices are likely to have efficiency cost or deadweight losses. For example, greater equity can be achieved through higher rate of taxes on the rich, but higher rate of taxes could also act as a disincentive to entrepreneurship and work, and discourage people from making savings and investment and taking risk. So there are two sides of the same coin. So this in turn will have negative consequences for economic output and productivity and growth of the economy. Consequently, the potential tax revenue may be reduced in future, and the scope of government's welfare activities would get seriously limited. As such, An optimal budgetary policy towards any distribution change should reconcile the conflicting goals of efficiency and equity by exercising an appropriate trade off between them. In other words, redistribution measures should be accomplished with minimal efficiency cost by carefully balancing equity and efficiency goals. Mark this. So we have to balance both of the things. Then we have 1.5 stabilization function. So macroeconomic stability is said to exist when an economy's output matches its production capacity, the economy's total spending matches its total output, the economy's labor resources are fully employed, and inflation is low and stable. The theoretical rationale for the stabilization function of the government is derived from the Keynesian proposition that a market economy does not automatically generate full employment and price stability, and therefore government should pursue deliberate stabilization policies. The market system has inherent tendencies to create business cycles. The market mechanism is limited in its capacity to prevent or to resolve the disruptions caused by the fluctuation in economic activities. The government and the country's central bank promote full employment and price stability through prudent fiscal policy and monetary policy. In the absence of appropriate corrective intervention by government, the instabilities that occur in the economy in the form of recession, inflation may be prolonged for longer period, causing enormous hardship to people, especially the poorer section of the society. It is also possible that a situation of stagflation, a state of affairs in which inflation and unemployment exist side by side, may set in and make the problems more complex. The stabilization issue also becomes more complex due to contagion effect, where the increased international interdependence and financial integration causes forces of instability to get easily transmitted from one country to another countries. The stability function is concerned with the performance of the aggregate economy in terms of labor and employment and capital utilization, overall output and income, general price level, balance of international payments, and the rate of economic growth. So stabilization function में क्या क्या है उसके ऊपर बता रहे हैं. So the stabilization function is one of the key function of fiscal policy and aims at eliminating macroeconomic fluctuations arising from suboptimal allocation of resources. As you might recall, the economic crisis that engulfed the world in 2008 and the more recent global phenomena of COVID-19 pandemic induced economic crisis have highlighted the importance of macroeconomic stability and have therefore revived immense interest in counter-cyclical fiscal policy. Means oppose the cycle of a business or a country. Counter means oppose. Government stabilization intervention may be through monetary policy as well as fiscal policy. Monetary policy through controlling the size of money supply and interest rate in the economy, which in turn would affect consumption, investment and prices. Fiscal policy for stabilization purpose attempts to direct the action of individuals and organizations by means of its expenditure and taxation decisions. We know that government expenditure injects more money into the economy and stimulates demand. On the other hand, taxes reduce the disposable income of people and therefore reduce effective demand. During the recession, in order to ensure income protection, the government increases its expenditures or cut down its taxes or adopts a combination of both so that aggregate demand is kept stable or even boosted up with more money put into the hand of the people. On the other hand, to control high inflation, this is ensure income protection. Government cuts down its expenditure, reduces the expenditure or increases the taxes. Tax, expenditure, year opposite ऊपर expenditure बढ़ेगा, tax कम होगा. In other words, an expansionary fiscal policy is adopted to elevate recession, and a contractionary fiscal policy is resorted to for controlling high inflation. The nature of the budget, surplus or deficit, also has an important implication on the country's economic activity. While deficit budgets are expected to stimulate economic activities, surplus budget tends to slow down economic activity. To sum up, this is very important. If there is high inflation, the government may decrease government spending, raises taxes, and reduces money supply. While if there is high unemployment, the government might increase government spending, reduce the taxes, and increase the money supply. There is often a conflict between the different goals and functions of the budgetary policy. Effective policy design to meet the diverse goal of government is very difficult to conceive and to implement. The challenge before any government is how to design its budgetary policy so that the pursuit of one goal does not jeopardize the other. Center and state finance. Fiscal federalism, a term introduced by Richard Musgrave, deals with the division of government function and financial relation among the different levels of government. Musgrave argued that the federal or central government should be responsible, federal or central, for performing functions related to economic stabilization and income redistribution, and the allocation of resource should be responsibility of the state and local. मीन सेंटर पॉलिसी डिजाइन करेगा और स्टेट जो है इम्प्लीमेंट करेगा उसको लोकल और स्टेट लेवल पे. So India is a federation of 28 states and 8 union territories. Fundamentally, federalism is an institutional arrangement to accommodate two sets of government, one at the national level, that is central government, and the other at the regional level. Each government is autonomous, mark this, and in its own sphere. An independent judiciary is established to resolve dispute between the central government and the state government on issues related to division of power. So यहाँ पे judicial system है जो दोनों में कुछ conflict है तो उसको resolve करता है. The Constitution of India had provided for the division of powers between the central and the state government. Article 246 of the Constitution demarcates the power of the union and the state by classifying their power into three lists. First is union list, second is state list, and the third is concurrent list. This is also important. The union list contains items on which union parliament alone can legislate. The state list has items on which state legislative assemblies alone can legislate. मतलब उनके powers और ये दिया है. और concurrent में जहाँ पे which both parliament and the legislative assemblies can legislate. और अगर in the event of conflicting legislation in the concurrent list, the law passed by the central prevails. अगर कुछ conflict होता है तो जो center करेगा वही ओके होगा. Allocation of revenue and expenditure responsibilities to different level of government is the fundamental matter in a federation. Sources of revenue for both central and state are clearly demarcated with regards to financial relationship and responsibilities between them. Taxes are levied by the center and the states. The central government has greater revenue raising powers. The union government can levy taxes such as taxes on income other than agriculture income, custom and export duties, excise duties on certain goods, corporation tax, tax on capital value of asset, excluding agriculture land, terminal taxes, security transaction tax. Central government, union excise duty, taxes other than stamp duties. यहाँ पे other क्यों बोला है उसके बारे में नीचे लिखा है. The state government can levy taxes on agriculture, land and building, mineral, electricity, vehicles, toll, professional tax होता है, collect land revenue and impose excise duty on certain items. मतलब कुछ पार्ट सेंट्रल के पास है, कुछ पार्ट स्टेट के पास है. The property of the union is exempt from state taxation. The property and income of the states are not liable to be taxed by the center. ये भी एक इम्पोर्टेंट चीज़ है. नहीं तो इनका इनकम पर भी टैक्स लगेगा. गवर्नमेंट से टैक्स ले रहे हैं. A significant element of fiscal federalism is intergovernmental transfers and revenue sharing to fulfill diverse national objectives. Since the states have comparatively less source of income, their revenues may not be sufficient to meet their expenditure responsibilities. There is substantial dependence of states on the union for securing necessary revenues. Article 268 to 281 of the Constitution contains specific provision in respect of distribution of finance among states. So distribution of revenue between the union and states is based on the constitutional provision as follows. Article 268, duties levied by union but collected and appropriated by states. Second, Article 269, taxes levied and collected by the union but assigned to the states. Article 270, taxes levied and collected by the union and distributed between the union and states as prescribed in clause 2 and the states. Article 271, surcharge on certain duties and taxes for the purpose of union. Article 275, statutory grants in aid from the union to certain states. Article 282, grants for any public purpose. And Article 293, loans for any public purpose. Hope the screen is visible. Because besides the above provisions enables transfer of resources from the state to the center to the states, a unique feature of the Indian Constitution is Article 280, which provides for an institutional mechanism, namely the Finance Commission, to facilitate such transfer. The Finance Commission is constitutionally mandated body that is at the center of fiscal federalism. It is responsible for evaluating the state finance of the union and the state government, recommending the sharing of taxes, tax क्या परसेंट में शेयर होगा वो recommend करता है between them, and laying down the principles for determining the distribution of these taxes among states. तो अलग अलग स्टेट्स को कैसा कैसा प्रोपोर्शनेटली होता है. जीएसटी में कुछ अलग सिस्टम है, इनकम टैक्स में कुछ अलग है, और इनकम टैक्स मोस्टली सेंटर ही करता है, वाइल जीएसटी में कुछ पार्ट स्टेट का है, कुछ सेंट्रल का है. द फाइनेंस कमीशन हेल्प्स इन मेंटेनिंग fiscal federalism in India by performing following functions. First, or A, the distribution between the union and the states of the net proceeds of taxes which are to be divided between them and allocated between the states of the respective share of such proceeds. B, determination of principles and quantum of the grant in aid, कुछ benefits to states which are in need of such assistance, मतलब कुछ state को ज़रूरत है तो वो भी डिसाइड करता है. To make recommendation to the president on measures needed to augment the consolidated fund of a state to supplement the resources of the panchayat and municipalities in the state on the basis of the recommendation made by finance commission of the state. स्टेट वालों ने कुछ दिया है सेंट्रल वालों के लिए तो उसके बेसिस पे कुछ रिकमेंडेशन कर सकता है. और डी, एनी अदर मैटर रेफर टू द कमीशन by the president in the interest of the sound finance. While recommending transfers, the Finance Commission considers issues related to vertical equity, that is, deciding about the share of all the states in the revenue collected by center, and horizontal equity, allocation among states, their share of central revenue. The Finance Commission broadly assesses the overall gross tax revenues of the union. Cesses, surcharge and non-tax revenue are netted out from gross tax revenue to arrive at the net divisible pool (NDP). Following a constitution amended in the year 2000, the divisible pool now consists of all taxes of the union. Considering the need of the central and the state government, the commission determines what percent of the net divisible pool should be assigned to the state governments. The balance remains with the central government. The 15th Finance Commission was constituted on 27 November 2017 against the background of the abolition of Planning Commission, as also of the distinction between plan and non-plan expenditure, and introduction of the Goods and Service Tax (GST). The Commission recommends that the share of the state is the central vertical devolution for the 2021 to 26 to be 41%, which is the same that of 2021. This is less than 42% share recommended by the 14th Finance Commission for the year 2015 to 20. The adjustment of 1% is to provide for the newly formed Union Territory of Jammu and Kashmir and Ladakh from the resource of the center. The criteria for distribution of central tracts among states for 2021 to 26 period are same as that of 2021. They are, or they is, income distance, that is the distance of the state's income from the state with the highest income, area, population, the old census one, democratic performance to reward efforts made by states in controlling their population, forest and ecology, tax and fiscal efforts. The introduction of GST, which was rolled out across the country on 1st July 2017, has significantly changed the state of affairs of financial relation between the states and center. GST आने के बाद बहुत कुछ चेंज हो चुका है. The GST subsumes the majority of indirect taxes, excise, service tax, sales tax, octroi, that is entry duty. The GST has made India's indirect tax regime unitary in nature, means सब तरफ similar or same base or same taxation. The state levy and collect state GST, that is known as SGST, and the union levies and collect the central GST known as CGST. For any particular goods or service or a combination of two, the state and the central GST rates are equal, the same rate लगता है. An integrated GST IGST is applied on interstate movement of goods and service and on imports. So कुछ एक स्टेट से दूसरे स्टेट जा रहा है, सेम स्टेट में है, मतलब एक स्टेट में ही ट्रांजेक्शन है, तो लगता है CGST और HGST. वाइल इंटरस्टेट है तो लगता है IGST. आप मान लो कुछ ऑर्डर कर रहे हो फ्लिपकार्ट पे से, और जो सप्लायर है वो में भी दिल्ली हरियाणा बेस है, तो आप जब इनवॉइस दिखेंगे उसका तो उस पर आपको IGST दिखेगा. कुछ बुक्स ऑर्डर कर रहे कुछ ऑर्डर कर रहे तो. और ऑन इम्पोर्ट है, इम्पोर्ट एंड एक्सपोर्ट पे भी IGST लगता है. IGST इज सिंप्लीफाइड अ कॉम्बिनेशन ऑफ स्टेट GST एंड सेंट्रल GST administered and collected by the union government, kept in the separate account and distributed between the union and the states after settlement of input tax credit and verification of destination of the goods and service. इसको मोर डिटेल में आप CA इंटर और फाइनल लेवल पे पढ़ोगे GST के बारे में. With many taxes subsumed under it, GST account for 35% of the gross tax revenue of the union and around 44% of the own tax revenue of the states. As per the Supreme Court verdict in May 2022, the union and the state legislators have equal, simultaneous and unique powers to make law on GST, and recommendation of the GST Council are not binding on them. ये ध्यान में रखना. ये मे भी एग्जाम में काम में आएगा, आपको प्रैक्टिकली काम आएगा किधर तो. The GST system replaced then the prevailing production-based taxation system with the consumption-based one. Since the manufacturing states have apprehension about loss of revenue, it was decided to provide compensation to state for loss of revenue arising on account of implementation of GST. तो GST होने के बाद मान लो कुछ स्टेट्स है जिसका रेवेन्यू पहले उनको डर था कि मान लो मेरा XYZ से 1 लाख मेरा रेवेन्यू है हर साल का, GST आने के बाद कम हो रहा है, तो फिर वो GST आने के बाद मे भी 80,000 ये होगा, तो जो 20,000 का लॉस है उसका कुछ पार्ट सेंट्रल गवर्नमेंट उनको फॉर अ टर्म ऑफ 5 पीरियड वो बेयर करेंगे और वो उनको पैसा देंगे. तो उसी के बारे में बताया. सो इम्प्लीमेंटेशन ऑफ GST फॉर अ पीरियड ऑफ 5 years, इट वॉज डिसाइडेड for to provide compensation to state for loss of revenue arising on account of implementation of GST आने के बाद for a period of 5 years from the date of its implementation. For providing compensation to states, a cess is levied on some luxury goods and demerit goods, and the proceeds are credited to the compensation fund. GST compensation was extended beyond 5 periods to enable states to tide over the pandemic-induced economic system. पहले 5 साल के ही था, 17 से 2022, पर कोविड आने से थोड़ा कुछ और लॉसेस हुआ था, उसको और 5 साल के लिए एक्सटेंड किया है. During the 5-year transition period, the top 5 GST compensation receiving states were Maharashtra, Karnataka, Gujarat, Tamil Nadu, and Punjab. The total amount of compensation released to the states and the union territories during the year 2020 to 23 was कितना है पढ़ो 1,15,662 करोड़. अभी रिसेंट में क्या है आप ज़रूर जाके बजट के पॉलिसी में देख के कमेंट कर देना. Insofar expenditure decentralization is concerned, the central government is entrusted with the responsibility of provision of nationally important areas like defense, foreign affairs, foreign trade and exchange management, money and banking, cross-state transport and communication. The state governments are entrusted with the responsibility of facilitating agriculture and industry, providing social sector services such as health and education, policy protection, state roads and infrastructure. The local self-governments such as municipalities and panchayats are entrusted with the responsibility of providing public utility service such as water supply and sanitation, local roads, electricity. For items that fall in the concurrent list, both central and state government are responsible for providing services. Borrowing by the government of India and borrowing by the state are defined under Article 292 and 293 of Constitution of India. The center may borrow within the limit fixed by Parliament by law upon the security of Consolidated Fund of India or give guarantee within such limit if any. The central government may borrow within the territory of India upon the security of the Consolidated Fund of the state within such limit if any, as may from time to time be fixed by the legislator of such state or law, or give guarantee within such time. The center may give loans to the states within the limit fixed under Article 292 and give guarantees in respect of loans raised by the states. Guarantee भी दे सकता है, loan भी दे सकता है. States need to obtain the center's consent in order to borrow it in case the state is indebted to center over a previous loan. कुछ नए लोन लेने के पहले प्रीवियस लोन के लिए लोन लिया होगा तो फिर आपको परमिशन लेना होगा नए लोन के लिए. दैट्स इट इन दिस वीडियो. ये समरी वीडियो में ऑलरेडी लास्ट अटेम्प्ट के टाइम पे कुछ रिकॉर्ड कर चुका हूँ इसका शॉर्ट वीडियो, तो आप वो भी देख लेना. और MCQ का कंप्लीशन जल्दी आ रहा है, उसके लिए एक शॉर्ट यूट्यूब वीडियो भी अपलोड हो चुका है चैनल पे, और स्लोली पूरा ही MCQ एक जगह पे कंपाइल करके आपको मिलेगा. तो तब तक के लिए चैनल को फॉलो कीजिए. कीप लर्निंग, कीप ग्रोइंग एंड कीप रॉकिंग. बाय बाय.